Hey, it's Soleil, and this is episode 255 of the Orange Pill Investor. And today I want to talk about a couple of the different ways that selling options can be viewed. And the first one is not necessarily very flattering to myself as an options seller, but I kind of look at it like trading for dummies. So, like, if you are just learning to ride a bike and dad puts on the training wheels for you, or you know you're a young bowler and you put the guardrails up so that you can actually enjoy the game and not hit gutter balls all the fucking time. That's kind of the way that I got introduced to selling cash secured puts and covered calls. And the reason why I say that, and it sounds like an insult, but it's not necessarily, because even like I think there's a statistic that showed that even medical doctors who should be reasonably intelligent, they can at least learn how to memorize things, if nothing else, they actually suck at the stock market. Like, they underperform. If they would just throw all of their savings into the S&P 500, they would do better than actively managing their accounts. So, sucking at picking stocks and managing the emotional roller coaster of knowing not to panic sell or whatever, that's not unique amongst people who, have little experience. Uh, but the way that selling options can help, in my opinion, is, for example, if I took two traders and I told trader A that they were going to buy stocks, sell stocks, maybe buy options, sell those options later, maybe exercise, whatever. I gave them all the tools. And then I told trader B, you can do everything that trader A can do, but you're going to get a 1% discount every time you buy something. And you're going to get a 1% uh, bonus on top of your purchase price every time you sell your asset. And which trader are you betting on doing better over the long run? Trader A or trader B, who gets a discount every time? Now, this may or may not apply to something that you have tons and tons of confidence in. So if you're just like, you know what, this is a sure thing, I know numbers going up, then maybe selling options isn't necessarily a an automatic benefit to that strategy. So if you've already got it all figured out, you probably don't need this video. But if I like MicroStrategy, but I don't like it at 216, and I'm like, okay, I'm looking at the chart, or for whatever, or your horoscope said that it's going to go down to 205. Well, you can set a limit order for 205, one share, and I'm going to have to put up $205 of collateral. I can't use that money. But if MicroStrategy goes to 220, 230, 250, 300, and we never see 205 again, then this was sitting in cash. And anybody who is even remotely laser-eyed probably believes that cash is trash, as I do. And and even more so, as an investor, you don't want cash, or you don't want anything to get no returns. So you don't own this, and you're never going to own it if the price never gets below your limit order. However, selling a put is like a monetized limit purchase. So if I go here and I sell a put for next week at 205, like I'm totally happy with 205. In the same way that somebody who put in a limit order for 205 and the price goes to 150, they liked 205, right? This is not promising that the price will go down to 204.99. You load up, you get your little discount here, and then the price goes up to infinity. That kind of shit is not promised. But the point is, trader A set a limit order for 205 that may never happen. Trader B places a sell put order at 205. And if that never comes to pass, that MicroStrategy goes below 205, this trader will have collected $500 on $20,000 of collateral. So you got to put up the 205 times 100. But the person who set a limit order at 205 for 100 shares also has to put up 20 grand. And getting paid $500 on 20 grand collateral is like 2.5% returns. Now, the correct play may have been just to smash the market bid. Like if MicroStrategy goes to 250 or 300 by next month, not financial advice, not a price prediction. This is just me ballparking, pulling numbers out of my ass. But in that scenario, it's just, just smash the price. Boom. I'll take it at the market price. If you think it's going up, then just buy it. But if you want a lower entry price, then it's possible to make money while you wait for this to fill. Now, there is one other little caveat to that, is that if MicroStrategy goes down to 200 on Wednesday and then back up to 210, well, then you're still just going to only get the $500 because this will expire worthless. So the limit order does have the advantage that there's no expiration date. It doesn't have to be timed. So there's always trade-offs. There's always trade-offs no matter what you do. If you choose one strategy, you're foregoing every other strategy. And every strategy has little, pros and cons to it. But the advantage to someone who doesn't know how to pick stocks for shit and has no idea whether MicroStrategy is going to go up, down, left, right, or whatever, is that even if I sold at the money, like, all right, I'm cool with 215. If I sell this one here at 215, instead of just buying it outright, if I do get assigned, then my cost basis is $21,500 for 100 shares, but I got paid $1,000 here. So really I got $1,000 discount on that. My cost basis, if I get assigned at 215, but I got paid $10, is really 205 per share. And then if I turn around and sell a covered call, maybe up here at 230, I can knock my cost basis down another $500, even at the 232.50. And just knocking it down 1% would be all the way at the 252 strike. So that's like what, $35 in call away value? It's like 10-15%. So it's not even forgiving all of the upside. But the point of this is, if I knock my cost basis down by 1% this week, whatever my percent chance of failing, like whatever my percent chance of choosing a shitty stock was, now my chances are 1% less. If I suck at picking tickers, well, immediately selling a covered call and foregoing some unlimited upside. And really, if you think about it, if you suck at picking stocks, are you really worried about missing out on unlimited upside? The biggest risk in your life is the damn ticker going to zero. Your biggest problem isn't missing out on winning the lottery. Now, for me, I'm starting to come around in the other direction because I have so much confidence in MicroStrategy that every time I sell a covered call, it starts to make me a little bit weak in the knees. I start getting a little sweat on my forehead. Whereas before I really started to understand Bitcoin and understand MicroStrategy much better, I never cared. I basically just ran the wheel. I'd sell puts until I got assigned. Then I'd sell covered calls until they got called away. I'd make my money, pay my taxes, and was perfectly fine with that arrangement. But where I was heading with that is, if you reduce your chances of failing by 1%, and then you reduce it by 1% again, and by 1% again, and 1% again, eventually, after 100 times of doing that, the stock is for free. If I get paid 1% and I repeat that process 100 times, now I've been paid the entire cost of my stock. And now I have 0% risk because I'm playing with house money. If my cost basis is reduced to 0, then it doesn't matter if the company goes out of business and I have to write it down to 0 because I'm just breaking even at that point. And then really, if I continue to sell covered calls against it, I could actually drive my cost basis negative. I actually would have gotten paid more than the purchase price. That is just kind of fantasy, really, because selling this covered call is about 0.15 delta. So about every 8 times I run this, maybe 7 times, every 6-7 times I run this, my shares will be threatened to get called away. Or if you don't have any money to roll them, they would absolutely get called away. So it's very unlikely that you would be able to sell 100 covered calls in a row and be like, okay, yay, I just paid, I own this stock for free. It's just a mental exercise to think of how those little small discounts can add up over time. And I'm basically quoting the Tasty Trade researchers. And the reason that someone might want to forego unlimited upside would be for a greater chance of success. Every time you give yourself a little discount, every time you reduce the cost basis, you have increased your chances of success. You have decreased your chances for failure and increased your chances for success. Now, with that being said, MicroStrategy has caused me to change my way of thinking. Assuming that the 4-year Bitcoin cycles continue, my strategy has been to sell covered calls after a rally and then buy not just shares, but buy long calls during the dips. And the long calls have certainly performed very well. And I got to listen to Ben Workman's interview on Tim Kotzman's channel at least one or two more times, because those damn convertible bonds that Saylor is selling sure sounds a hell of a lot like covered calls to me. Investors are paying him a bunch of money, like when I sell a covered call and I collect a premium, and then they can convert at some strike price. I think Ben said it was like 30% out of the money or something. In the future, they can convert those into shares, and then they take the profits. Now, of course, they have a whole, the way I explained it, they have a whole hedging strategy. And yeah, I got to listen to it a couple more times and probably go down a whole another rabbit hole. But I am loving the way that my mind is being stimulated by these irresponsibly long MicroStrategy conversations. And yeah, and the point is, Saylor doesn't just take that money so he can sit on cash. He's not just like, okay, yeah, let me just have cash now so that it can be eroded by inflation. He's going back to the honeypot and buying more Bitcoin with it, and basically making his shareholders happy by diluting the shares and then making them more valuable in the long run. And so that's kind of the way that I've started thinking about this as well. So MicroStrategy's volatility is on a whole nother level. But back when we had this huge pump in the price, if you were smart enough to time the market and say, okay, when it was pre-split $500 a share and it went to 1,000, you might have sold. And when it went to 1,500, you might have sold more. And when it went to 2,000, you might have been a fucking genius and sold that tippy top. But what also, I don't really do technical analysis. I guess if I did, I'd probably go just all in and learn every damn last thing I could. And there's some impressive traders that claim technical analysis has helped them make some money. So they seem credible. So I'm not tempted. I'm tempted not to argue that point. But for me, if I know that MicroStrategy's baseline 30-day implied volatility average is 60, 70, and then boom, implied volatility cranks double. When is this? This is March 4th through the 14th. Let's check the price. So March 4th, boom, through the 14th. This is when option prices should be at their peak. When implied volatility is cranked through the roof. So the price being up could be a sell signal in and of itself, but accompanied with a dramatic increase in implied volatility could be one extra indicator of hey, it might be time to start selling covered calls. Going back and looking is at the chart is cherry picking. It's, you know, it doesn't mean that this will exactly happen next time, but it is definitely something to think about. Selling covered calls between whatever this is, yeah, March 13th and the 27th would have absolutely printed, because especially if they were at 45 days to expiration, which gives them a little bit more time to be right, which is a little bit different than the weeklies that I generally have preferred to sell. Even if you were a little early here and you sold a 45 days on this March 15th, 45 days would have get you to end of March, end of April. So boom, right here. Worst case scenario, these probably would have just been break even. Probably would not have had to pay to roll here. Then again, even if so, on March 4th, yeah, see, March 4th would have been a little bit of a problem potentially. Let's see here. On March 4th, if we caught this little semi peak and sold the 150s for 45 days, we would be getting wrecked through here until about, what do we got to look at? Like April 18th. But we would have caught this downturn here. So if we were able to manage here, that might have worked out. Otherwise, what did I say? March 4th to about April 18th. No, that might have worked out. Yeah, that would actually been fine. So the weeklies are playing a little bit more playing with fire, but the 45 days to expiration out of the monies are a little bit safer, with not only catching a dip that you can use to close your position down, but also implied volatility is a mean reverting statistic. So in general, you can kind of see what MicroStrategy's baseline is. This looks like it never really returned to its old baseline, though. So this IV 6070 looks like we may have a new baseline of like, old baseline looks 70s, new baseline looks like 7080. All right. So so the first thing that I wanted to cover, and I'm only going to cover the second part very quickly, was giving yourself a little bit of a discount, collecting a little bit of premium can help you get into a trade, but also reduce your cost basis, which is, especially someone that's like just starting out. I don't even read the 10Ks and all of that happy horse shit, really. I think I've read one. Probably should, I suppose, but I seem to be doing fine without spending time on it so far. So, not sure it's even a good use of my time. But the second part would be how to take profits. And it's a little bit what I was just talking about. So, I mean, just the price going up. So the price went from 50 to 100, 150. I mean, that seems like that's a pretty decent sell signal. It does still scare me with a little bit with MicroStrategy where it can go up 4x in 4 weeks. I think those moves might start to get even a little bit more violent. But if I have 1,000 shares, I can sell, one covered call at 150. I can wait if the price goes up to 150, I can sell one at 175, 200. And then at some point, I could do that, like what? Add one extra covered call in every week for 10 weeks. And in that case, I would have caught the top, basically. A couple, a couple might have been at risk of getting called away, 150s, 175s. But beyond that, adding more covered calls on every single one of these pumps would have added a little bit of profit in there. Even if the overall long-term expectation would be to hodl forever. And then end game, like even so Punter Jeff was getting interviewed by Tim Kotzman as well. And I'm still in the middle of that one. And every time I watch these guys get interviewed, it's like, okay, now I have 2 or 3 ideas for things that I need to explore and talk about. But, he was talking about the bull bear cycle could be kind of interrupted for MicroStrategy if they kind of play the MNAV game and then there's passive inflows with the index funds and things like that too that could cause MicroStrategy to not have as dramatic a bear cycle as we're used to seeing with Bitcoin. And we know that MicroStrategy is not going to stop buying Bitcoin. So that may actually even alleviate some of Bitcoin's bear markets. Like if MSTR is buying the dip every damn time, uh, maybe we won't be getting quite as much volatility. But along with that is being able to at least just kind of, for me, I don't want to work. I don't want to have a real job. I guess posting on X will be my job if I can ever get monetized. And I'll use my $10 a month or whatever to buy fractional MicroStrategy. But even if that's the case, MicroStrategy, like any stock, is going to still follow support and resistance. So there's support until there's not, and then you get resistance, and you get resistance until there's not, and then it finds new support. So that's still going to happen. It may not be quite as volatile, and it may break the 4-year bull bear cycle, but there's still going to be support resistance. There's not just going to be number go up forever without dips. So I still think, even if that's the case, in 2025, my end game will be way more aggressive. So right now, I kind of got shell shocked. I'm a little bit scared of the covered calls because of these shenanigans right here. This 4x in 4 weeks type of shit scares me. But at some point in 2025, after I've seen a bunch of these happen, it seems inevitable that MicroStrategy and Bitcoin hit resistance at some point, and then there should be some opportunities to trim positions, not necessarily by selling the shares outright, but at least just kind of putting them at risk and selling covered calls and accumulating either cash or putting them into another asset. And I know we like to say there's no second best, but if you agree that a position should be rebalanced, then there's got to be some kind of profit taking, or at least deleveraging. Otherwise, it would just be rolling long calls forever. It would just be buying whatever. I got the December 2025s. And then once December comes around, I would just be rolling these out and rolling these out and rolling these out forever. If I just thought it was number go up forever, then I would do nothing but roll my long calls to higher and higher strikes forever. But I don't know if anyone is that irresponsibly long and willing to just suffer leveraged collapse in the price if the bear cycle does rear its ugly head again. That just doesn't make any sense. So it seems like at least at some point in 2025, converting all of these long leveraged call positions into shares at least makes sense. But if it makes sense to do that, then it kind of simultaneously seems like it makes sense to sell covered calls. If you're admitting that leveraged long positions are no longer worth the risk to reward, then it seems like that, once I make that mental switch, like, yeah, I don't want to own any more long leverage positions. It also seems like that sentiment might also be ripe for selling covered calls and accepting some premium for unlimited upside. I mean, after the damn stock has 10x'd and you've captured a metric ass ton of unlimited upside, I think that at least kind of makes a little bit of sense. That risking what 100x, I suppose. I mean, it could, but that at least makes a little bit of sense to me. That a covered call strategy seems like a reasonable addition to a long-term hodler's, diversification, not necessarily of assets, but diversification of strategy. So I talked, as usual, I talked way freaking longer than I expected. So I'll leave it there. Be good, Joe.